So what's the difference between an advisor and a planner, at least as per the industry? What's the difference?
Um, our firm kind of breaks it down in a way that's in this as simple as I could put it. The advisor's focus is relationship management, whereas the planners are um, I can't remember the word they use, but it's more of the research development um, type of yeah, and the analytic side of the planning of the plans.
Sure. Yeah, I'd agree with that. Um, so it's incredibly confusing to people on the outside what we even do. And also there is these little maybe nuggets of hints at kind of the scope or uh the ethos of what a firm would choose, the path they choose to go down, right? So, like if you're going through the process of getting credentialed, you're taking, your Series 7 or Series 66 or what have you. Uh, they're going to use this language and terminology that is very technical, right? And so you're actually called investment advisor representatives. Um, so, however, in the field, usually there is a little bit of a difference between a financial advisor and a financial planner. As a matter of fact, I try not to even use the word financial advisor as much as I do investment advisor. To your point, Evan, investment advisors often are seen as wearing the hat of managing portfolios and taking care of the investment side of things. And so financial planners typically, not always, right? And sometimes these definitions get crossed and mixed and confused in a thousand different ways. But a financial planner is someone who's kind of looking at trying to kind of create a plan for somebody, right? Like a holistic, comprehensive financial plan, very similar to what you guys are doing through this Capstone project. And so I'm always quick to tell people, like when they come in, they sit across the table from us. Most of them think that I would be there simply and solely to be their investment advisor. Right. I'm going to try to take their funds. I want to try to invest them for a fee. And so a lot of times what we have to do is we have to kind of reorient that discussion to say, listen, it's actually is not quite like that. We would, potentially want to come into a relationship with you so that we can manage your investments, but it's going to be built alongside of a larger financial plan. Uh, and so that's really what drives, right? The investments is what you have going on in a plan. And so at that point at least our process is like today I sit down with a couple and the husband goes, he starts by going, uh, here's my wife's stuff. We want to move it to you guys. So it's just, whatever you need to do to drop the paperwork. And I always have to stop and because this happens often, right? And it's like, well, thank you. We're hopefully excited to work with you as well. Um, but we want to get to know you. We don't feel good about making recommendations for you without getting to know your situation. Getting to know who you are, right? Like, um, we want to be more than just a transactioneer, a place to house retirement accounts because she was stopping work at her 401k, the place where she was working. It's like, no, no, let's back it up and try to kind of figure out that relationship that we want to build with you as a client. And so I really like that. Like it's really healthy. I think that I've been afforded the opportunity to work at a place that's like that because not everyone is not all firms are going to be building out plans and doing that. Some of them, it's just not their model. Some of them are going to be more that investment house. Like, hey, we're just going to manage your investments and we can answer one-off questions for you. But what the plan's going to be, is kind of just a little bit of you know, what it seems like that might be the best option for you. So I kind of backed them up a little bit, told them, we would want to, get to know more about their whole picture, what she has, potentially coming down the line in Social Security, what a new job would look like when she, transitions, what his situation is like. And so, that was, that's a common thing. Like people don't necessarily think when they walk into the doors of a place that's going to have financial planning, they don't know what you are or what you do. Sometimes they think you're traders, like investment analysts, or that you're behind the desk, always and constantly trying to make decisions for portfolio optimization, or that you're going to be you know, um, rolling over your portfolio, 50 times a year to try to gain whatever. And so that's rare. I don't know. I guess maybe it happens places, but anyway, wanted to talk over those differences and those nuances because that language does matter. And so, yeah, I have to put on my card investment advisor representative, even though I don't really care to use the word investment or advisor in my title. We like and all of our guys in our office, there's seven of us, we do team planning and building and things like that, but we go by financial planners. At least that's what we like to call ourselves. So we try not to be too snooty about it. Anyway, that being said, let's dive into this lesson right on the investment side of things, because we always tell people, yeah, it is a big hat that you do wear. And oftentimes it is what they are expecting from you when they're coming through the door. Hey, what should I do with my investments? And so, really, what this lesson does is it goes all through these different 5 reasons, or kind of situational factors that are going to affect investment planning. Okay, risk tolerance, expectations about market conditions, client's knowledge or experience, how to kind of gauge that, the time horizon, and then the capacity that they might have to handle risk. So, like right off the bat, kind of let's start from the bottom up. What do you know about the Doss household? What is their capacity to handle risk?
Seems to be all over the place.
Yeah, right.
Bitcoin and a while swings there, but also there's, I think, a note on Devin's concern with the volatility of the market. So
Yeah.
it seems mixed.
Also, they expect 40% return.
Yeah, that's right.
That had to
Yeah,
have been
that's
words out
ignorance.
of someone's mouth. Like, I don't think you could even make that up. Someone actually probably had to have said that. So there are people out there who think those things. Yeah. So, um, oh man, I forgot. So, okay, let's talk a little on risk tolerance. I'm going to jump all over the place. Okay. There are a lot of reasons, like a lot of, as you go through the requirements as a fiduciary, right, to make sure that you're gauging your clients' levels of risk. That's kind of a big key point, right? Are you making sure that you understand your clients' appetite for risk, their capacity to take volatility? Because there is, and truth be told, a lot of people out there who their story involves them getting out in 2020. They got out in 2008, they got out in 2001, and then they got back in when the markets had risen. And then they wonder why their average investment yield is like 3%. And they're in the market. It's like, well, because you didn't have a capacity for it, and yet you still chose to invest. Furthermore, if you're not properly lining out the expectation for the volatility that you might expect to see, then a client could very easily come to you and be like, what's happening? Why are accounts moving down? What is this down 20%? And so I actually had this client, I just couldn't stop thinking about them today. So they had $106,000 in their retirement account. Um, he had more in his. He works at a factory. She worked at a hospital. Um, she was invested there in their stable value fund. It's at Fidelity. It yields a 1% return. And she told me that she started that 36 years ago, and she has never changed the allocations. And she was self-admitted that like she knew like I should have more in my account. I didn't know much. I was never educated on investments. I didn't believe that I wanted to try to experience, the ups and downs in the market. So I took the stable value option, 1%. And so, I'm preparing this lesson after this meeting, and I'm kind of doing the math on it. So I kind of figured up that she contributed $2,460 a year on average over 36 years, right? So she has $106,000. So what do you guys think? Knowing you're smart, the time value of money, what's the amount if she had invested it in the market and she had received a 9% return on her money, how much would she have in her retirement account? Just off the top of your heads, or if you had the calculator out, you could run the numbers. What do you think?
You said 2,600 a year?
Yeah, 2,460. So less than 2,600 a year. 36 years. Joe, you gonna take a gander?
I'm getting there. It's gonna be a while here. I don't have it right in front of me.
Ballpark of like maybe 1.5 million or something like that. That's just a ballpark guess.
Sure. Yeah, not quite that high, but still a
Feels
lot.
like a million. That was kind of my guess.
Yeah, it's 580,000. But think about how life altering that would be right now for her. She's actually she's gonna stop working at a hospital and go be a travel nurse. Work for a couple of years. Hopefully they make a lot more money than traditional jobs, but her kids are all out of the house and she's decided she wants to do that. But the difference between 106,000, so she's actually lost purchasing power, right? Because she hasn't invested that money in anything of real substance. But the difference between those two figures are just there's such a disparaging difference there. And so it's really, I always have to check myself to be like, okay, listen, you're not going to ever help someone by shaming their past or telling them they should have done something different. I didn't do that in this case, but like thinking about the risk aspect, right? What is risk? Because sometimes risk does need to be redefined. Risk as it relates to the regulatory environment of our financial planning world tells us that we need to understand our reward, but also the risk that goes with it. Okay. Risk in maybe a more practical sense would be defined as not having the money when you need it or it not being there. And so inflationary risk and the risk that you're taking by not investing your retirement funds when you're young, especially by putting them into at least predominantly a market exposed in a portfolio, that risk is very real. And like that client, is a great example of that. Not the only one we've seen like that, but like she could be very comfortable between the small pension she'll get, her Social Security, and that amount with her husband having about the same amount in his retirement account. But she hadn't taken she just didn't know, and was worried and concerned, and maybe that was something that was even maybe and she had mentioned this, her family none of them believed in markets, you know, or the gambling in the stock market, as sometimes they put it. So a lot of times our job, right, is to come alongside of people and help them feel more comfortable by providing some of that market exposure that they need in their plan. You know, so that's a big thing in our world, is figuring out how to define risk. And so, you know, not that I'm trying to redefine it, because it is a compliance regulatory thing too, but risk is not having the funds when you need them. And so expectation, going on to the second one about future market, is a big deal as well. And so a lot of times this perception is framed within some questions that you might ask. And so here are some different questions that people have asked before. I think some of this can be helpful. I think a lot of questionnaires are not very helpful. Our office, just to be honest, we ask the question like, what are you most concerned about? Retirement, the market downturns, inflation, all these different things. I'd rather take these questions because I think it helps us a lot of times get to an answer to a question, even if it's not answering that question, right? Number one, I will be honest, so many people would answer B to number one. So many people would answer B to over the last 5 years if it read like that to begin with, which is crazy, right? You know, because the last 5 years, you know, markets have done really well, but people will anchor themselves to 2022, and sometimes even make it, you know, political or whatever. And it's like, man, we've had some good times. Markets have done really well, and you haven't heard that. Even if you have an account that's showing those numbers, those raw hard numbers. Satisfaction numbers, you know, 10-point Likert scales are always fine. Good questions to ask. I did a lot of research on financial satisfaction. So kind of it's important to gauge. Some people will come in and they won't have much at all, but they'll still feel good about where they are because they'll explain the story of where they've come from too. Right. So, and then some people are extremely well off and have the 7-figure retirement accounts, and then they're also they don't think they're doing too well. So you know that all plays into it. So anyway, what are we measuring here in these questions? You know, if you really think about it, if you really look at it, what are we measuring? There is a expectation piece, which we talk about there in the word above, but then there's also a financial education question, really. How, you know, an undergirding, right? You're always want to know a little bit more about your clients because they might just not have the education that they have had needed to make good decisions in the past. It might not be at all about bad decision making. Oh, this person is just spends all they have, or they're mired in credit card debt. It might just be an aspect of the fact that they've never been taught the right things. And then salience, a lot of times these are measuring just how financially aware people are with reality, with where they stand. So time horizon, probably, I would say, the biggest one, most important one of all 5 that we see here: risk, expectation, knowledge, time horizon, and capacity. Because if you really think about it, time horizon should really drive our investment philosophy and where we're at. So often you see people in our world, you know, who say, well, like the traditional idea of, what should I do with my investments as I get older? I should shift from more stock to more bonds, you know, in a smooth pattern all the way from, you know, my working days to the start of retirement. And then at that point, I should be in, you know, my age, 100 minus my age, have that exposure in bonds. And so, I always tell people time horizon planning is really the heart and soul of what we're doing when we're trying to figure out how someone's situation is going to drive their portfolio and where we're going to put them in. And so we do a little bit of bucketing at our work, but typically it's there so that we can understand how to create, especially in retirement planning, when you get close to the need for that money, right? At that point, then we don't want to have too much market exposure. So like say within the next 5 years, if you know for a fact you're going to need funds in the next 5 years, then the market, I mean, it's 70% of the time up, but the 30% of the time that it's not up, it's not good, right? And that's not fitting for most people in their need. And so we're going to go ahead and shift our investments to take the need that they would have over the course of maybe the next 5 years out of the retirement account. We would put that in a bond fund, right? That's going to be yielding, but it's not going to have much volatility. And then we're going to put the rest in a stock fund. But I will also say that, again, the concept of risk is oftentimes misunderstood, right? And so bond funds in 2022 are just the classic example of how you really oftentimes are not, you can't always trust that bonds are going to be the safer place to rest, right? And equity and the market is going to be the riskier option, because a lot of bond portfolios and a lot of bond funds still have not recovered from 2022. So here we are nearly 3 years into the future, and those funds, at least their values, have still not bounced back. And so, take the Doss family. The Doss family, what they have 30-year bonds. So what's the purpose of those funds? What do you guys think? Why would they be invested in 30-year bonds? Anybody have any ideas on why'd they do that?
They probably wanted the stability of it.
So
As a
what
way to like reduce the risk because they have other.
So what would have happened to, so just say they go out and buy the BLV, the Vanguard Long-Term Bond Fund. What do you think would have happened between 2021 and now?
Probably would have been losing value, depending on
Yeah,
when they entered it. Yeah.
yeah. Right? Like bond funds still trade, and they trade relative to, where interest rates have been and where they're going. And so I know for a fact that if that say they were in a bond fund like that, it's probably down 30% and probably still hasn't rebounded. Right? So like it's possible, and I get it. It has been an extreme example what happened between 2021 of nearly zero interest rate environment to where we went to after all of the inflation and the spike in interest rates in 22. But there's still risk there, and there's a lot. Most people are not going out and buying 30-year treasury bonds at Treasury Direct, right? Like they're not holding those to maturity. They're going out and buying funds that still trade and move with the market. And so there is still they have this idea, and that, granted, the betas are lower, the volatility is lower, right? But you can still find yourself in a situation where those bond funds, right? As a matter of fact, I think the BLV probably traded at like 110 in 2021, and it's still at like $75 a share now. Yeah, right. And if you bought it at 110, it's not paying you 4% like it is now. It's still paying, whatever the you would have bought it at, really. And so all that being said, a lot of times there's a lot of misconceptions about long-term bonds maybe being the safer option out there. And especially in the present world, that's not been the case. And so it's going to be a long, slow march back to even for those people. And so But yeah, all that being said, time horizon is integral, and I really do think that's true. Like if you're outside of retirement planning, if you have funds and you're looking to try to allocate them, whether it's 529 account funds for your kids getting ready to go into college, you need to start shifting that allocation when they're in high school because you never know when the next big recession could hit. If you're looking to buy a house with maybe some taxable funds, right? And you're playing the game of allowing them to grow in an investment. But you're trying to, of course, figuring out, should I be more in the market or more in bonds? Well, the time horizon will give you the answer to that. So there's only actually been one 10-year draw down in the market. Historically speaking, that was 2001 to 2010. Market was down 1%, right? So, a lot of times that risk reward, where should we be invested, how to, wherefore, most people, especially when they're young, especially with retirement accounts, probably would do better to move out of maybe even target date funds and allow them, their funds to be invested in all equity. Slowly shifting those maybe into a little bit more bonds, maybe in their 50s. But that, of course, all depends upon where, what they need. And so capacity is the next one. And so here you see capacity, of course, is really the things that kind of go alongside someone to tell them if they're able to accept risk. So any questions up to that point? The different aspects, situations, right? What people come in with, that's going to affect how we would love to come alongside them and invest with them, in those ways. All right, let's talk a little bit about the investor policy statement. So these are really good. I've only done these for nonprofits, and so I'm really excited to kind of see what you guys are producing here for this. But basically what this is kind of an agreement between the client, between the planner, about how all of this is going to work together. Okay, so you can see an example of the student managed fund that they have here at Biola. And so you've got also some other examples he has linked to down here. But these are really good tools because they provide us an opportunity to understand more, right? About how we're going to be investing, the guardrails maybe we would be using. If you're going to invest someone in a unique type of portfolio, your methodology, well, any methodology is good, right? But also methodologies within a type of investing portfolio. Like here's the biblically responsible investing methodology. We have delineated we've got several different faith-driven portfolios, which are pretty neat. Like we really enjoy the process of that. We've got a kind of a strict portfolio and then a normal portfolio. But we, go ahead and delineate that for clients because it's good for them to see the methodology of us as we go through making investments on their behalf. And we'll say most of these things are kind of industry standards, right? Like you actually can't have, more than 50% of portfolio in an individual type of investment. And still be able to draw an asset under management fee from them. So there are some things that are also like, well, this is always going to be the way it is, but it's good for them to understand, like we are diversified. We will be investing our, different bond and stock strategies in this and that. And at times we can take discretion and move funds from one to another as need be and as seen fit. So, I will say this one is probably going to be a little longer than what you would have. But you get the template, let that kind of drive your process. We draw these up for all our nonprofits, but I kind of like the idea of using them for everybody. It's also good too, because at times when markets are down, people need reassurance. And so, they also need reassurance that they've committed to something, not just their financial planner is committed on their behalf to a investment directive or strategy. And so that is there's something firming about that when you put pencil to paper or pen to paper and you're signing to make those decisions.
So it's just basically a guiding document on the approach that you're going to take to the handling the
Correct.
investments. Yeah, okay,
Right.
got it.
And I will say probably most places that, we only do these for nonprofits because a lot of times that's a requirement. They're going to take these papers back to their committee or board
Yeah,
to discuss that. But even with individual clients, what it does is it allows them to see your method, your portfolio creation method. And so, it really is an educational tool as well as a commitment piece.
absolutely.
Yeah. So yeah, then this is kind of just talking over through some different, we're not going to go through all these in individual, and most of you guys should know what all of these different investments are. Um, some of these are never going to be fitting, especially for what you're going to probably be wanting to do. I mean, there's a lot of news out there. Take REITs, for example, not real estate, but real estate investment trusts. I'm not talking about REITs that are publicly traded, I'm talking about privately traded REITs. So much out there of advisors that went out and promised the moon to their clients with this product. And then, sure enough, it ties up their money in illiquid processes where maybe they can only get their money out after a certain amount of time, and privately held REITs have kind of hold all the cards in that regard, and they can even change that from what they had set up whenever you'd put money in. And so there's a lot of planners out there who put people's retirement funds in these illiquid options, and what do you know, retiree needs a distribution out of that, and you're toast, right? All of a sudden you find yourself on broker check because you've had so many red flags or client complaints lodged against you. So in the end, what our investment philosophy is at our office, we have an option to be able to put people in all bonds or all stock, but right, like you kind of grow to develop a portfolio that you really do genuinely feel is going to be in the best interest of a typical client, right? So our all equity portfolio, it's going to have the base of the S&P 500, and then you're going to mix in some growth stock, some value stock, some mid cap and small cap, and that's all backed by research and literature that having those pieces firing is good. So take small cap, mid cap, for example. Mega caps have dominated the market in the last year and a half, well, more than that. But it's been even more pronounced as time has went on. And so it hasn't paid at all almost to be in these the smaller 3,200 stocks in the stock market out there, right? Like the top 7 have really dominated, shown the growth, and that's really where gains have been shown. Well, like even just a week or two ago, when it was pretty certain then from some remarks from the Fed that we're going to see interest rates finally start to be on the decline, probably just 25 basis points, and probably in September. Well, we saw small cap, mid cap respond well to that news, right? And so we actually saw money flowing out of mega cap for the first time in a long time. And it was actually moving not out of the market at large, but into these other aspects and areas of the market that had kind of just been sitting dormant almost for a long time. So it's good to have exposure, all right, to this diversified portfolio, because maybe not all the sides in the market are always going to be firing at the same time. And maybe not in the last 5 years, you probably have more if you didn't invest in the small cap, mid cap, but kept everything isolated and, the top cluster of, the Magnificent Seven or whatever they're calling them. But in the long run, you do want to have at least a little bit of exposure to that, even if it's just 5 to 10%. It's good to have a little bit of international exposure, but not too much. A lot of times when we meet with clients who are in 401k portfolios, a lot of them have 30 or 40% exposure to international, which is way too high. So we usually try to tell them, listen, we want to dial that back. Some of those are even in portfolios that they don't create. Those are in target date funds and, kind of set it and forget it, cookie cutter options. But first off, America-based companies versus, domestic versus international. Our domestic companies are all or multinational global corporations. And so you want to have, exposure to international. You're going to have it even with domestic plays. And so it's good to have some international, but probably no more than 15% in that. So that's the kind of thing that we focus on in our world, and then after that we sprinkle in some unique ETFs that are just going to give us options to kind of dial in or dial up our play in say materials or financials or things, healthcare, things like that. So um one thing it talks about here when it talks about these correlations, it says in a high inflationary environment, commodities work well, and in low inflation environments, stocks and bonds are better. And so we saw that in 22, right? Commodities, real estate did do fairly well, especially commodities were the only thing that worked. Commodities, oil and gas, and utilities, maybe a few of the, high earner or yeah, value plays were about the only things that were working. So it's important to be able to have all of that in a your general good diversified portfolio. So, and finally at this end, it's almost like an appendix. We've got some different formulas that we see, variance and standard deviations, coefficients, betas, and things like that. So finally, there's some general investment strategies. We've talked a little on this one, right? Dividend paying stocks can potentially reduce tax costs after you've held them for more than a year and they're long term at that point. Even your ETFs are going to be about 90% tax efficient, right? And so for the most part, so an ETF might be trading in and out of different types of securities. And so those short-term gains might produce inefficiencies for that. But for the most part, they're nearly qualified, right? Some different plays on tips and things like that. I bonds were really popular even just in 2022. People bought into so many I bonds that the Treasury Direct had to redo their website because they had too much traffic coming in because they were paying 9%, right? Markets were kind of cratering a little bit, and but the I bonds are kind of an interesting animal because they've got a fixed interest piece, but then they also have the inflationary adjustment, right? So if you were able to get the fixed interest before we really saw the inflationary adjustment increase, that's where you got that like 9 or 10% yield. Of course, that inflation, thankfully, right? Because inflation rates didn't last for very long. That amount came down to like 3% last year. And so all those people getting, who had thrown money into these I bonds, I think you could do $10,000 per person per year, have really shifted out of that play because now it's yielding like 3 to 3.5%, which is uh lower than what you can get like at an online savings account. So anyway, it's interesting to see how quick people are to attach themselves to this or that thing, trying to make a little bit more. So there are some other things too. I mean, you can always write calls or even puts to increase your portfolio income. That is a high energy type of option out there, right? It takes a lot of effort to do that. I mean, you can yield at times upwards of 20% doing something like that, but it's going to require weekly and sometimes even daily attention to those because it does take a little bit of effort. So And what that is, say you take I don't know, a blue chip company like Ford, you go out and buy an option. You're basically in a way taking a calculated bet that the stock is going to rise to a certain level. So let's say Ford's trading at $14. I buy a $15 call. It expires in 1 month on August 25th or whatever. Usually all call options expire on the Friday afternoon at 3:30. So you've got an option to, basically exercise that call, once it hits the strike price. Or you can just trade in that call option, let someone else exercise it, and basically take the gains. And so what it does is it's just magnifying glass on gains, but what it also does is it gives this time value implication to it, right? So the time value is going to be diminishing as it gets closer to that expiration date. Now, if you're writing calls, okay, you're the one who's receiving the income. And basically at that point, you're saying, listen, I don't care. Even if the stock does go up, I'm going to go ahead and take my interest, and I'm okay with, the 3% you're going to pay me, to go out and buy that call. So. We saw a lot of laddering going on with CDs and treasuries, of course, the last couple of years because of the rise in interest rates. And so basically what you're doing at that point is you're allowing one one CD or a bond to come due and then going out and purchasing another one. And so, it kind of takes out a little bit of that future interest rate risk. Like if interest rates really do crater, or they go down fast, we find ourselves in a recession, and potentially it could, you know, lock you in for a little bit longer while also still allowing you to reassess your funds as they come due. All right, y'all. We've come to the end of the road for tax planning. I will tell you that one interesting aspect of the DOS household is that they don't really have much of any of their money in a conventional investment strategy, right? So like you can go a lot of different places with this. But definitely would probably recommend that you guys at least have some of their money moving in the direction of what you would, say is a normal type of investment portfolio. So even his 401k has got issues, doesn't it? Yeah, you guys watch what Starbucks been doing lately?
Yeah.
Yeah, not so hot, apparently anybody can make coffee, and some people think that their coffee is actually not that good. So I don't know how you guys feel about it, but I'm not a big Starbucks fan.
Neither am I.
All right, Sergio, anything? Jason, Evan?
Nope.
All right, guys.
Thank you.
Yeah, appreciate it. Have a good evening. Feel free to holler at me as things come up. All right.
Thanks.
You bet. Have a good one.
Thanks, Alex, brother.
Thanks.